All right, first Greece, then Spain, and many investors eyeing Portugal as the possible next debt domino to fall in Europe. But as Bloomberg's interactive insight team has been reporting, 14 out of the 16 Eurozone countries have failed to be in compliance at some point with the EU's fiscal rules about maximum debt to GDP or economic output, and that's that deficit ratio to GDP ratio. So should Portugal be singled out? My next guest doesn't think so, and he's got some details. Jose Maria Ricciardi, he is the chief executive of Portugal's Banco, Espirito, Santo, the Investimento. That's the investment bank. Mr. Ricciardi, welcome to Bloomberg.
It's a great pleasure to be here with you.
Talk a little bit about what's happening in Portugal, and as you just described during the break, it's different in Portugal than it is in Greece. Why?
And in Spain, it's different. I understand, first of all, that in trading rooms it's very difficult. Sometimes it's more difficult to make those differentiations from the reality, but it is different, and I can give you 4 reasons. We have a smaller debt to GDP than Greece, and it's a significant difference. We have a lower deficit, even being the deficit in 2009 was a high one, but even so smaller and lower than Greece. We have competitive advantage because of our relations and geographical situation with Southern Africa and with South America, namely with Brazil, which is very important for our companies. And our accounts are more accurate, more reliable. So I think that I gave you 4 examples, but our situation is completely, I will say, different from the Greek one.
Okay, so you've got a situation where you're talking about transparency of accounts.
Exactly.
You've got better trade with Latin America and Africa.
Not only better trade. We have entered in, when we were today in Wall Street with the main 20 companies of our country that are listing in the NYSE Euronext Lisbon, we have explained that those companies, for example, they have already almost 50% of their equity value. It's outside the country, and namely with this part of the world, with important investments they have made in those parts of the world, and also with the exports that they make to those parts of the world, because we have a very special relation with those parts of the world, and this is, I think, a competitive advantage taking in relation to other countries in Europe.
So not dependent on the domestic economy as much.
Exactly, less, and having a capacity of growth of our own companies because of this strategical relation that we have with countries like Brazil, that, as you know, some centuries ago it was also Portugal.
Talk a little bit about the strain that a country like Portugal is feeling because it is in the EU. I mean, at 121 versus the dollar, do you think the EU is going to allow parity versus the US dollar?
No, it's going to be difficult. The EU is going through difficult times, and I think one of the reasons is because the EU doesn't have really a financial coordination, and the European Central Bank is not having the role that we think that they must have, like, for example, the Fed, the Federal Reserve, has had here in the end of 2008 and in 2009, and so we have a common currency, but we don't have still the tools to manage the difference between the countries with a common currency, like yourselves. You have made so well in the peak of your crisis here in the end of 2008 and during 2009.
All right, we're going to leave it there, but I want to thank you very much, Jose Maria Ricciardi, Chief Executive, Banco, Espirito, Santo, Investimento, sharing your thoughts on Portugal with us. Thank you very much.